All right, welcome everybody to the Wide Lens Podcast, episode number 13. We're recording this on Friday, the 22nd of April, and I'm joined here by Matt Rigby, and I'm coming live from sunny Gold Coast, which isn't very sunny today, but the last few days have been pretty bloody good. Let's get straight into Matt's Market Minute.
Hey guys, it might not be sunny, Rob, but you're still in t-shirt, mate. It is freezing down
Oh,
here.
is it?
Unfortunately.
T-shirt and shorts, man.
It's so cold this morning. All right, let's get into it. So the ASX, the last 5 days, up just under 2%. Year to date, it is flat, down 0.02%. Interestingly, up 11% from the lows on Jan the 27th. And I was shocked when I saw this. The ASX 300 is 28 points shy of an all-time closing high, which I never would have guessed. So just really interesting there. Ramsay Healthcare under takeover offer up 29% over the last week. PME up 9%. Challenger up 9% on profit outlook being pretty good. Brambles up 9% on profit outlook being quite good. Santos up 3%. Profit good, buyback, dividend policy all changing. So companies that are earning and making good money are being rewarded. Megaport, however, came out and disappointed. They dropped 16%. Year to date, so that's all in the last week. Year to date, on the telcos, Telstra's down about 4.25%. Aussie Broadband's up 25.5%, TPG up 3%, and Unity Group up about 8%. So quite a divergence there. The smaller telcos doing quite well. The Nasdaq 100 over the last 5 days up around 0.5%, down about 14.25% year to date. 71 stocks positive over the past 5 days, which is pretty interesting. Year to date, 54 stocks down more than 10%. 22 stocks in positive territory. S&P 500 up about 1.4 over the last 5 days, down about 6.5 or thereabouts year to date. 416 positive over the last 5 days, so really good 5 day, although only up 1.4, so that's interesting. Year to date, what have we got? 227 stocks positive, 180 down more than 10%. The leader, Occidental Petroleum, which Berkshire Hathaway has a very big stake in, rumored to be taking over, they're up 112%. Netflix down 62%. Year to date. Just a few stocks that have come out with earnings over the last week. Bank of America is up about 1%. They beat. Schwab's down 12%. They didn't. American Airlines, United Airlines both beat. American's up 6%, United's up 12%. Netflix, as we mentioned, they actually beat on earnings. We'll touch on this later. They're down 37% for the week. And Tesla's up about 1% for the week. They also beat. So pretty clear trend there. Emerging markets, the down about 1.76 over the last week, down about 12% year to date. Oil down 4.5 over the past week, still up 30%, 32% year to date, trading at about $104. And Bitcoin up about 1% over the last 5 days, down about 14.5.
Why is emerging markets continuing to get crucified? Like,
I think the strength in the US dollar's got to be part of it. So typically, emerging companies in emerging markets will borrow in US dollars. So as that US dollar strengthens, their debt repayments become more or higher. So that I would imagine that's part of it. I also wonder whether it's a bit of a flight to quality, so money going out of these markets into the US markets. The S&P is doing all right, down 6% year to date. So I suspect that's part of it. And it could be also just moving into cash, short-term debt instruments as well. So it's certainly one to watch, because at some point they're going to turn around, and you would imagine they're going to turn around pretty quickly. But that may be some time off though.
Yeah, it seems to me there's this massive divergence between there's no consistency in this market. The breadth seems to be quite narrow as well. Notwithstanding your comment on 416 positive stocks in the S&P 500 over the last 5 days, which I thought was interesting.
Yeah, I think that's a bit of an outlier, though. I don't think that's been the case the last.
No, it hasn't.
So
No, it hasn't. Okay, cool. Look, let's get into the first topic, and we talked about this a couple of weeks ago. Castle, who I subsequently worked out are a security firm, and so all this data that they're giving us around office occupancy and so forth, what they do is they track the fob, your beep passes when you go into the office and so forth. So they know how many people in the office, when they're beeping in, when they're beeping out, and so forth. I'm going to get this chart up now. I wanted to bring up the updated data. So the return to the office, the return to normal but not to the office is the chart that they've had for a couple of weeks updated now. If you remember, that red line at the very bottom is the office barometer. And if you remember, it was sitting at 38% last time we looked at it. We talked about the Omicron dip you can see there in the back end of 2021. But interestingly, and look, I don't want to spend too much time on the top lines, which we established last time. Most people going back to NBA games. People are traveling. You can see the TSA checkpoints, and you can see open table dinners or diners as well. Now, the thing that I'm looking at is the 42.8%. It is the highest reading since this whole thing began. And I think that's really, really important for a whole bunch of reasons, whether it's economical reasons or whether it's for business in general, especially in small businesses. Culturally, I think is really important. I just read on the news that Victoria, and I don't know if any other states are doing it, they're lifting the mask mandates. And in fact, vaccination mandates, which is ironic, and what all of this means for economies and for businesses and so forth. The comment I make about businesses, occupancy does seem to be slowly coming back. Having said that, I think a lot of these businesses have got leases that have been in there for a little while. So it's not like you can just terminate a lease and not occupy the office space anymore. So what this doesn't show is it doesn't show who's leasing or what's vacant or what's occupied. It's just showing who's actually going into the office here. And I talk about why this is good for business. Anecdotally, I've been up here in the Gold Coast for the last week. What's going on at the moment is insane. There's this massive discrepancy between big businesses and small businesses. Small food businesses, for example, it's like a day-by-day proposition. Whether they can get stock or whether they can get staff will dictate whether they're open that night or whether they're closed. But you go to a Guzman and Gomez, you go to a Grill, you go to a Hunky Dory, and they are absolutely jamming. And you got to wait for a long bloody time to get your food. I was chatting to some friends that we've made up here, and they went to Movie World with their little ones, and they got there at 9 o'clock, and it was a 2-hour wait on the Scooby-Doo ride, and they said we left at 11 o'clock, and it was just that insanely busy that they couldn't even deal with it. So theme parks seem to be pumping. We're in Surfers Paradise because the kids love it. And the main areas, the main streets and the main drag is just absolutely chock-a-block. Absolutely chock-a-block.
Yeah.
What do you think about occupancy and, what all of this means for businesses, what it means for, Melbourne culture, for example? I saw Sally Cap on the news this morning while I was at the gym. I don't know what she was saying, but I just saw her, with her hands and talking, whatever. But what are your thoughts about all of this with occupancy starting to rise? I mean, notwithstanding US data in Melbourne and more generically, I guess.
Yeah, look, I think you're making an important distinction between the small and large businesses. I was out a couple of days this week just during the lunch time and even after that, and there are people everywhere. And something I noticed, and is probably a general observation, but there was a lot of foreign languages that I could hear. So whether that's tourists being here post the Grand Prix, whether, I don't know what it is. I mean, they could be locals, who knows? But just anecdotally, that's something that I haven't noticed, haven't heard, haven't seen that volume of people around this year. So no, I think, and it's school holidays as well. I guess that's the other factor. This is probably not quote unquote normal. But I think people want to get back to normal. They need some normalcy in their lives. And I think traveling and getting out and coming into the cities is all part of that. And I guess the next step is getting back into the office. So, we've certainly seen, I'm noticing the trains are a lot fuller in the mornings than they were, say, 2 months ago. Whether that continues throughout the rest of the year. But on the flip side, I'm still speaking to a lot of friends, a lot of people who are saying, I'm only in 1 day a week, 2 days a week, not interested in going in any more than that.
Are they big companies, Matt, or are they small companies? Like what are they?
There's a bit of a mix, Coles is one, couple of IT, NBN, those sorts of businesses. So they're reasonably big, and interestingly, their managers are happy for them to just be in there 1 or 2 days a week. It's almost like just show your face every now and again. How
much of that do you reckon is governed by what governments are mandating or dictating? Like now that all that's gone,
I don't know. Is it one of those things where once the genie's out of the bottle, it's hard to get it back in? Once you've given people a taste of that. Work from home, pick up the kids, don't spend time in traffic and all the rest of it. Is it hard to get everyone back? I know that we've kind of talked about this as well. I don't know. I've just got this belief that 2 or 3 days a week will become the normal in the office. But, you mentioned a few weeks ago that once we go into a recession and employment is scarce, because you can get a job easy at the moment.
Yeah.
When that changes, maybe the whole dynamic changes. I don't know.
I came across this additional data just to add to what you're saying about whether, depending on what maybe industry, national occupancy is sitting at 42.8. But if you carve out law firms' average occupancy in the US is sitting at 70.3%.
Wow. Okay.
And I don't know
That's interesting.
what the law firms are doing differently or what they want to do differently. Whether their work means that they need to be face-to-face or whether, trying to do things remotely with more than 5 or 10 people just becomes impractical or impossible. I don't know. But it was an interesting distinction that Castle made with 42% versus 70% for law firm occupancy. And that's across the board in the US. Washington, New York, Chicago, even Houston, not really. So I thought that was interesting, seeing that number be the highest it's ever been since the pandemic broke out. I also feel like, Matt, do you remember when online shopping was going to kill shopping centers? Like when you can do, when you can do click and collect? Like that was going to be the death of shopping centers. No one wanted to buy shopping center stocks. And interestingly, do you know what the numbers are? I looked these up last night when I was just updating the doc. Do you know what global retail sales were as a portion of sales globally in 2019? Take a random guess.
So in-store sales as opposed to online?
E-commerce versus as a proportion of global retail sales around the world. Percentage.
It's interesting. I heard a stat recently that in the US it's like 15%. So I'm going to say like 10%.
It's 14.1. That 15% is pretty close.
Yeah, right.
And
okay.
the prediction is for 2023, e-commerce will make up 22%. And so I say that because I feel like when these things happen, like everyone just goes to the absolute extreme. Like what did shopping centers do, man? Like you never used to be able to go to the movies at the shopping center. You couldn't have dinner at a shopping center now. But look at what Westfield are doing. Look at what Chadstone are doing. Even smaller, more suburban stores. You've got, a whole bunch of more variety in there. You've got food courts in there now. You've got gyms in these places where you wouldn't have had. And maybe that's bullish on suburban shopping centers if people are working from home more. And you've got amenities such as gyms and, it's not like hairdressers weren't amenities beforehand. But I just don't think it's going to go to a 0 to 100 of everyone in the office versus no one in the office. My view hasn't changed. I agree with you. I think a 2 to 3 day at a minimum is going to be the norm.
Yeah. And, the shopping centres have become a destination, not just for shopping.
But I think that's why office needs to be the same thing. Like, I think building owners need to have other amenities, such as end of trip, even have gyms in there now. I remember companies used to have childcare facilities in the big buildings as well. I think all those things will come back.
Yeah, no, I agree.
Let's maybe wrap up on this one. We've gone a few minutes over on this one, so maybe over to you.
All right, so I'm looking a couple of articles I came across about property, and the first one is focused on Hong Kong, which is interesting for a whole bunch of reasons. Obviously, the China influence and what's happening on that side of it. But it caught my interest. So this is an article from Bloomberg that Hong Kong home price sellers wonder how low asking bids will go. So essentially what's happening is forever Hong Kong property prices have been going up, and that's been a fairly steady trend and a fairly stable trend. I think we'll bring this, I was going to do my second chart, but I'll bring this one up first. So Hong Kong's property prices have risen annually in 17 of the past 19 years. Now that's one hell of a strong property market. And one of those declines was barely, that was 2020, it barely went down at all. So really 18 of the past 19 years, property prices have gone up in Hong Kong. So people are finding that it's becoming more and more difficult to sell. So Hong Kong property prices have fallen more than 6% since their peak in August. Probably not too bad. With no quick recovery in sight as residents leave the city at record rates. I think that's interesting. Some analysts are predicting another 20% slump by 2025 due to rising mortgage rates and a slowing economy. I think probably for me, one of the interesting factors is the number of residents leaving Hong Kong at the moment, and they might be replaced by mainland Chinese citizens, but certainly the influence or takeover, we'll call it, of Hong Kong by China has had an influencing factor there. And they had a few different individual stories, and some were moving to the UK. They interviewed a guy from New Zealand, and he said he wasn't looking to leave Hong Kong soon, but wanted to sell his property to get money out of Hong Kong/China, right. Implying there that capital controls and all the rest of it would likely follow. So I found that pretty interesting. The other point to note here is, and we'll bring up this second chart, which compares Hong Kong to a number of other cities around the world, being London, New York, Toronto, and Tokyo. And you can see Hong Kong in the teal color, I think that is. And they're lagging. This is since 2018. So they're lagging in property price appreciation. But one thing to note is home values in Hong Kong have increased 449% since the last major trough, which was in 2003. By comparison, the US home prices have gone up about 100%. Now, two very different markets. Hong Kong's very concentrated, very densely populated. The US obviously spread out across rural and metropolitan. But I just found that pretty interesting.
Isn't that chart just flat? Like, isn't that teal color from 2018 basically just flat? I mean, relatively speaking, yeah. Yes, it's lagging. But to your point, a 450% rise since 2003. Like, how much more do you want this thing to continue to go up?
Yeah, that's right. And look in that first chart, that bar chart, there's been some pretty strong years. 2004 looks like it's up about 35%. 2009 up above 20%. I think there's 5 years where they've had 20% growth since and including 2004. So you're right. I mean, how much more do you want? But anyway, so buyers are getting a little bit worried. Then I came across this second article, which was again in Bloomberg, and it was about the US. So US buyers are beginning to get discouraged, and there's a chart here which we'll bring up now. The likelihood of buying a house in the US dropped to the lowest level since 2014. And this was a survey released by the New York Fed, I think it was on Monday. Yeah, by Monday. On Monday.
So what is it saying?
Yeah, so they're basically saying that potential home buyers getting discouraged by rising mortgage rates and home prices, which are still increasing, and I guess the rate that they've increased over the last couple of years. US consumers expect mortgage rates to increase substantially over the next several years, with households on averaging projecting rates of about 6.7% a year from now and 8.2% in about 3 years. So right now, the US 30-year mortgage rate sitting at around 5%. So expecting another 1.7 over the next 12 months and about another a bit over 3% over the next couple of years. So that's, anecdotally maybe taking some of the heat out of the market, although new starts are still strong. A couple of the home builders have announced results recently, and they're seeing, still pretty robust demand. Completions are still going strong. So, as we saw a few weeks ago, that the sentiment tends to lead all of that. Once you start building a home, you don't stop because things are not looking great. You keep it going. So they tend to be a little bit more lagged as well.
Like how much do we want to? How much value do we want to place on these? This survey done by, notwithstanding who it's done by, like the likelihood of buying a house. I'll just say, it's unlikely. I mean, how truthful are people in these surveys?
That's a good point, and we've seen that in a lot of consumer sentiment.
Yeah, we talked about this like 3 or 4 weeks ago, right? Like what people are
retail
saying
sales
versus consumer sentiment versus retail sales. It was sentiment was super low, retail sales super high.
Yeah, exactly right. And there were a couple of other stats in the survey which were pretty interesting. So respondents surveyed by the Fed said that they anticipate home prices in their zip code to rise by about 7% over the next 12 months, up from about 5.7% over the last 12 months. So they're clearly not feeling too, that's existing homeowners. So they're feeling pretty good. I guess it's maybe people looking or potentially looking to buy into the market. Interestingly, renters weren't expecting any relief, so they're expecting rents to be increasing by about 11.5% over the next 12 months, and they're up about 6.6% over the last 12 months. So, I don't know, my takeaway is the housing market is tight in the US. New entrants are not feeling great about it, but they're probably resigned to the fact they're going to have to pay more to get in, and rates are going up. But to your point, it's not impacting prices right now, and maybe these things. I've never paid a lot of attention to it, but maybe they take 6-12 months to really kick in. As maybe this is the first wave of people starting to feel a bit despondent, and as interest rates go up, that likely spreads, which is the whole idea of raising rates. So. It'll be something interesting.
Why do you think the Hong Kong property market thing's important? Like, you always see the likes of, whether it's Vancouver or whether it's Hong Kong or Sydney, like these are typically, we've talked about this in previous episodes where you've got, it's least affordable. Like Hong Kong's been the least affordable, one of the least affordable cities in the world, if not, I think it's the number one. Like I think it is the number one. Why is that so important that it's risen so much, and the fact that people are calling for like a 20% decline? Like, is that such a big deal? Like, what impact does that have?
I don't know. I think probably for me the interesting part, maybe it's interesting because Hong Kong's such a financial hub for Asia, and with China and all their moves, there's been the concern that Hong Kong may lose that status as a financial hub, and that moves elsewhere.
Isn't London supposed to lose the status of the financial hub? Like, whatever happened to that?
For Brexit? Yeah, look, I got no idea. We'll ask our friends in London. But yeah, I've got no idea. But I think probably the thing that stuck out for me is just how consistent the Hong Kong property market had been over such a long period of time, which I had no appreciation of. And it's China, their growth is slowing. Is this a bit of an early indication that maybe financial engineering and all the help that the Chinese government have provided for the broader Chinese property market, which they've always used as a bit of a leverage to kind of jumpstart growth. Is it running out of steam? Is it or are there other factors, and that being people leaving Hong Kong because of the Chinese influence?
I don't know how quickly that stuff changes, though, Matt. Like, if you look at major cities around the world, how long they've taken to get to the point where they are now, I just don't know how these things change overnight or at the flick of a switch. Maybe, since 2018, we saw Hong Kong property prices not growing, and maybe that's what happens for a prolonged period of time until it becomes more affordable. Some stats I was looking at was even though the prices are going up, like if you look at different ratios, the income and affordability, it was even more expensive if you looked at a whole bunch of ratios, but it's come down. It's become more affordable, notwithstanding the fact that it's the most unaffordable housing market in the world. It's become slightly more affordable. And if you look at some of the you made comments about government and whatnot. Some of the stats that I was pulling out, Hong Kong's population is just under 8 million people. It is the 8th most densely populated city in the world. Like, just think about that. The 8th most densely populated city in the world. And these are just some observations that I'm making. To me, it seems like there is a huge demand to be living and working in Hong Kong. To your point, it being one of the world's financial hubs. While you were speaking, I was just looking up London property prices. London property prices, if London was not going to be the financial hub of the world anymore and property prices are going to fall, I'm just looking at just a random chart here that I've just Googled. I can't even see prices falling in this chart. You've got some bumps along the way, but the median or the average house price in London is at an all-time high since 2007. In fact, it's up.
Yeah, right.
Up maybe 50%, maybe more, 60% since then. Land is absolutely scarce. If you look at property in Hong Kong, they're basically enormous towers wedged in between mountains. Like, it's insane. Vacant land is all controlled by the government, who, from what I understand, sell to Chinese property developers. And what I didn't know, which I only recently found out, was almost half of total housing supply is through public housing rentals and assisted home ownership programs, which are intended for lower income families. Do you know they account for about 45% of homes? Meaning only...
Yeah, that's interesting. I didn't know that.
Yeah, which means only like half of the properties that are on the market are actually available, housing is actually available on the private market.
Which, probably plays some way into why it's so expensive.
And then you look at Hong Kong from a tax haven. It's very attractive, and the government makes most of their money not from tax but from property revenue. And then I just wonder then what is their incentive to curb prices? I think they can manage it a lot. I think they've got a lot more control around how they manage that, which maybe is not dissimilar to Australia.
Yeah, true. Well, it's interesting you mentioned about Australia because another article I saw from the Financial Review is that foreign buyers are returning back to the Aussie market, which I know we've mentioned a couple of times that prices have gone up despite foreign buyers coming in, and that was foreign buyers were the scapegoat for prices going up a few years ago. So the NAB have come out and basically said so foreign buyers are surging back into Australia's new housing market, accounting for about 8% of the demand for homes across the country.
Is this currently?
Yeah, that's across the March quarter. But interestingly, in New South Wales, it was about 1 in 10 new home sales were going to foreign buyers. And it's the third consecutive quarterly rise, which kind of lines up with Australia starting to open up.
I agree.
The pandemic starting to ease. So I don't think that's a huge surprise, but I was just interested by that number.
What do you mean it's not a huge surprise? Like, people were talking about the property market's going to collapse because there's no foreign buyers. We saw property prices rise, insane, 21% last year.
Yeah, it's not a huge surprise to see them coming back in. I think it's pretty natural that, borders open up. Australia did.
No, but I think people didn't think
well.
that was going to happen. I agree with you. It's not a surprise to me. My feeling was that we'll see it come back, but I think a lot of people were talking about foreign buyers not coming back again. Who would want to come to Australia was the question.
Well, who'd want to come to Victoria? I think Melbourne was specifically.
Mate, everyone's in Queensland
right. I think
at the moment.
Yeah, that's it. But back in, I don't know when it was, at the height of the housing boom in 2014, close to 17% of property purchases will buy foreign. So we're still
you say that like it's this massive thing. 17%. That's like less than 1 in 5 people. 1 in 6 people.
Yeah.
So if there were 100 buyers,
true.
There's 100 people buying houses. 17 of them were foreign. Like, I feel like it's not as ridiculous.
Just adds to existing demand, right?
I don't know what it's like. Supply. That's the issue. Supply is the issue.
I wonder what it's like in the US or Europe, like the UK. It's probably much higher, I would imagine, in Europe.
What's that? Foreign buyers?
Foreign buyers, just because Europe
geographically
so closely.
Yeah, that's right.
Yeah, exactly right. Sorry, I just found that interesting. NAB are saying that prices will go up this year in Melbourne and Sydney, but likely fall.
I thought prices were supposed to fall this year.
No, they've changed their tune. They've decided it's going up this year.
Okay.
And across the country, 9% next year. And finally, they're just saying the Reserve Bank will raise rates to about 1.75% by the end of 2023 and about 1% this year, which interesting. All very interesting. So we'll see. I mean, no one knows. Everyone's guessing. Everyone's expecting prices to fall. It may not happen. Foreign buyers might come in and save us. Who knows?
There's always something, right? Like, you look at what's going on with investment markets at the moment. A lot of people, a lot of funds, a lot of fund managers had missed out on this whole because they weren't so heavy in tech, and then they got into the high growth tech stocks that crashed. Then they had no exposure to value stocks or oil, and then there's always something to blame after the fact. And like when do you stop blaming something and then just believe that whatever it is that you're doing may or may not be working? That's a whole nother topic. I do not want to go there. I will not stop talking about it. Let's jump on to did you want to talk about anything else on property? I feel like that was interesting. I didn't realize how much foreign buyers were coming back. That doesn't surprise me though. No, it doesn't surprise me at all. No, let's move on. Let me just set the scene here at the moment. I read this piece by Verdad, which I just want to go through. I'm just gonna go through it, and then I want to get your point of view on it. This is really, really surprising to me. Currently, we're seeing inflation that's reached the highest level in decades. The Fed is raising rates. No one wanted to own bonds in the past because yields were so low, right? And now no one wants to own bonds because rates are rising. And the consensus viewpoint is sell your bonds as fast as possible because rates are rising and you will get crucified on your capital value. I saw this piece by Verdad, which did a real deep dive into this, and I'm just let me run through it. The research basically disagreed with this, and it was a real surprise to me. What they were saying was that rising rates tends to be bad for all asset classes, not just fixed income. And in fact, fixed income actually tends to perform relatively well with significantly lower drawdowns. I want to get this first chart up here now, which shows the federal funds rate with hiking cycles in grey bars. So the blue line is the Fed funds rate, and then you've got hiking in grey. Now, notably, hiking cycles were much more prevalent if you look from 1954 to 1982, and it's 71% of months versus 39% after, which I think we all know that. I want to bring up this next chart now, which shows asset class returns and the drawdowns during hiking and easing cycles from 1954 to 2022. So the first line is easing cycles. You can see the S&P 500 is typically up during an easing cycle. 10-year treasuries are up about 6%. High yield bonds up 10%. Gold 7, oil 1, inflation's about 3. Hiking cycle, the S&P 500 is up 9%. US treasuries up 4. High yield bonds 5, gold 7, oil 10, inflation's running at 4%. And then you can see the worst drawdowns, minus 51, minus 19, minus 33, 62, minus 96% oil, which I think that was in 2020.
2020.
And so except for commodities, all asset classes appear to do worse during hiking cycles. I think that's just like we just know that. But the gap between stock and bond returns are significantly smaller when the Fed is hiking, significantly smaller. The S&P 500 outperformed 10-year treasuries by 11% during easing cycles, but by only 5% during hiking cycles. 1970 and 1982 is a period that most investors worry about when we talk about bonds, when we talk about inflation, etc. So I want to get this second table up. And it's asset class return and drawdowns during hiking cycles 1970 to 1982. Have a look at the S&P 500 during that hiking cycle, down 6, treasuries up 3, high yield bonds up 4, gold up 20%, oil up 18, and then you have a look at the worst drawdowns as well. Now, nominal equity returns during this period were negative, and real equity returns were even worse. When you've got S&P 500 down 6, add inflation onto that, you're down 10% during hiking cycles from 1970 to 1982. 10-year treasuries, interestingly, after accounting for inflation, were down 1%. Now, in all of these hiking periods, all classes of bonds outperformed equities. And they also did it with lower drawdowns. And this whole concept of inflation protection of equities, this comes during, easing cycles rather than hiking cycles. And bonds just seem to have done a better job offsetting inflation in tightening cycles. And the point of this is not to say that we're going to have a repeat of what we saw during the 1970s to the early 1980s, rather to say that in hiking environments, the risk reward for owning equities becomes worse. And maybe it's an opportune time to be looking at diversifying from, if you had a portfolio that was all equities, this is what Verdad's point of view is that if you've got a book full of equities, that maybe that you want to start looking at diversifying your capital for a period of time. And the research shows bonds actually isn't a bad place to be. And bonds just seem to be, if you look back in history, going all the way back for the last 70 years or so, that they actually do a better job of preserving capital while delivering some sort of return to offset inflation during that time. Now, all of that was... So let me rephrase. Not all of it was surprising. There were a number of aspects of this piece of research that were surprising to me. What's your point of view on this and in light of this piece of research?
Yeah, look, it's really interesting. And I guess that second chart, from 1970 through to 1982, I mean, that was pretty extreme. I was just looking at the first graph you brought up. That was some pretty extreme hiking cycles. I mean, looks like they're every other year there's another hiking cycle. Yeah. So, pretty extreme times. But I think, it goes back to, I guess, what you learn at uni all the way back in those days, that, fundamental portfolio construction consists of a defensive part of the portfolio. And while that maybe hasn't helped you over the last 20 years or so, when interest rates have constantly gone down, I think there's always a case for having, an allocation, depending on your risk profile and appetite, but having an allocation to fixed income and cash, and it's not all doom and gloom. And as rates rise, there's periods where bonds will fall in price, but they're falling less than equities. And maybe those periods are shorter, and that's where you get that, indicating that positive return. But also, I guess the flip side is that as bonds mature, you're rolling into high yielding
100%.
new bonds. And then you're locking in a higher yield, and at some point rates start to come down, and you've locked in high yields, and you get the benefit. And it's market timing is, we've said numerous times, it's impossible. So don't bother trying it. Just stick to well diversified, well allocated portfolio, and over time, over many cycles, you'll see that it comes out. You come out all right. But this was pretty interesting. I hadn't seen a lot of this sort of research into bonds and their performance during different cycles.
I think you can manufacture.
Clearly,
sorry, go on.
I was just going to say, clearly outside of that 1970, 1982 period, which was pretty extreme for interest rates, then just based on this table, you would infer that during hiking cycles, generally stocks do all right as well, which is pretty interesting in going against the current narrative.
But it's all a relative game, right? Like the research shows that everything goes, like rate rises and the fast-paced rate rises are not good for any asset class or most asset classes.
That's right. Yep.
And so it's a game of relativity, I think it becomes. And look, anyone can manufacture a narrative and come up with this story about why it's different this time. But, we've got 70 years of data here that's telling us one thing, which it helps me sort of reshape my thinking towards all of what is going on. And I think you've hit the nail on the head. Not a lot of people think about the fact that if you're buying bonds now at 90, 85 cents in the dollar, as those bonds mature, you're going to start picking up bonds with high yields. And so you kind of need to take a step back to go 2 steps forward. You're not going to be able to have, unless rates rise, how else are you going to get higher rates of return on your bonds?
Yeah. Yep. And if you're buying at 98 cents in the dollar, they mature at 100. So you get a little capital kick there, and then you're rolling into a higher yielding bond.
We haven't seen bonds crashing for the last 20 years. And so everyone's shitting themselves because we're seeing, and we talked about it last week in the pod, right? We saw long bonds that have fallen 20, 23%. Yep. We're talking long bonds, 20, 30 year bonds. You don't have to buy 20, 30 year duration bonds. You can buy short-term high yield bonds. You can move higher up in credit. Like there's just so many ways that you can, and that's why I think that having like a fixed income ladder from low to high risk profiles of fixed income makes a lot of sense. Look, let's move on on to the next topic.
Yeah, so this one kind of in the same vein. God, we're very economic today, aren't we? So recession risk rising, or maybe it's not actually. So this article out of Bloomberg from Goldman Sachs, and they see the US recession odds at about 35% over the next 2 years. I'm just trying to think. I reckon we saw something like this fairly similar.
Yeah, Deutsche Bank, 20%.
I was trying to find it, but I couldn't. Was it Deutsche? Yeah. Okay.
Someone had to get better than Deutsche Bank.
So now Goldman Sachs are trying to outdo them. So it's 35%. A couple of interesting points here. And there was one really interesting kind of overall view, which I'll get to in a sec. But basically I was saying that the Fed Reserve face a difficult task in trying to managing inflation while trying not to kill off employment and just cooling the economy, which is incredibly difficult at any point in time, let alone through supply chain issues and everything else that's going on. So the Fed's main challenge is to reduce the gap between jobs and workers. So that is have the unemployment rate at a steady rate, but not constantly falling, which then kind of translates into pressures on wage growth, which is they're trying to slow wage growth but not kill wage growth off, while trying to manage inflation all at the same time. And so it's hard enough, to kind of hit one of those targets, but all three of those targets is incredibly difficult. And this guy, the chief economist from Goldman Sachs, was basically said that 11 out of the 14 tightening cycles in the US since World War II were followed by a recession within 2 years.
11 of how many?
Which I think 11 of the 14
Right.
tightening cycles, which I think we've looked at previously, but their research was saying that only 8 of them can be even partially attributed to the Fed tightening.
Say that again. Only 8 of them can be contributed partially.
Even partially attributed to the tightening. So what they're basically saying is, even if you're being really critical of the Federal Reserve, you can only attribute 8 of those recessions to the fact that they raised rates
Of the 14.
too far. Of the 14.
So it's like 60%.
Yeah,
Okay.
thereabouts. Yep. And so soft and soft landing have been more common recently, which was interesting, and projects the odds of a recession over the next 12 months of being only 15%. So what I take from that is, over the next 12 months, the economy can take it, in their view. But when you start going out a little bit further and rate hikes start to bite and they start getting higher and higher, then the chance of a recession, again, in their view, is higher. So this is interesting that, it would appear that more and more people are starting to talk up recession. And if we know anything about recessions, is the more that you expect it to happen, the more likely it will be to happen.
You reckon?
Yeah, well, they're all about expectations, right? I mean, if consumers have it in their mind that there's a recession next year, you could probably almost guarantee.
Who cares what the consumer thinks? We've seen it doesn't matter what the consumer thinks.
Well, they start to pull back spending. So if
people are waiting 2 hours to go on Scooby-Doo rides. Like people, like that's the barometer, not what people think.
Yeah,
it's people are waiting in line for stuff like this. People are. You can't get a hire car here. You can't get into a restaurant. Like, who cares what people think?
If there was broad-based expectations of a recession, that stuff stops. People don't travel. People don't go up to the Gold Coast. They don't, they stay closer to home.
Do they?
So it's absolutely. I mean, if you were...
But you're saying that's if we are in a recession. If people are getting laid off.
No, that's expectation. So if people are anticipating a recession, traditionally, spending will start to decline. And that generally will lead to a slowing of economic conditions, which generally will lead to a likely recession or a general slowdown. So I guess my point is, the more people think it will happen, the more likely it is that it might happen. So
I'll take the other side. I'll take the other side on that.
Right.
The more people think
I don't know how we're going to prove this.
The more people that think that it
I take the
happens,
challenge.
I reckon the less likelihood that it's going to happen. And look, I'm sure there's a chart, and I'm sure we can put it together about recession expectations versus lag lead on actual recessions, and maybe we might just have to run that chart through Refinitiv.
Yeah, I think we need to. The challenge has been set.
But we talked about this a few weeks ago, where everyone seems to be talking about the next thing that's supposed to happen in a business cycle, which is inflation. Rates rise. Rates need to go from 0 to 5%. And then after that, there's an inflation. Like, why isn't anyone talking about... after there's a recession. Why isn't anyone talking about what happens after a recession?
Because we're not there
You
yet.
go on a tear. Yeah, but we're not at a recession. Like, could it be at all possible that we are at the beginning and on the verge of a new bull market? Because this whole tightening cycle we're talking about, it's just that we're just right at the beginning. It's not at...
What is your premise, that the tightening cycle doesn't go for as long as what people are expecting, and therefore there's a snapback in, it's not that bad?
No, because recessions happen
in.
at the end of the tightening cycle. So they tighten. You have a recession, cut. Like, we've just started this process.
Yeah, right. So you're saying there's a potential rally into a theoretical recession?
I'm not saying we're not going to have a recession. 100% we're going to have a recession. I just don't know if it's going to be in 6 months or in 12 months or in 18 months' time. What I'm saying is that I feel like, and when you look back in history, typically recessions don't happen at the beginning of tightening cycles. They happen at the end of tightening cycles. Yep. And so if we are at the beginning of a tightening cycle, and maybe Jan Hatzius is right, like maybe we've got 12 months of tightening before we hit then a recession, and maybe between now and then central banks have raised rates. I don't know how many times, but we saw, I think New Zealand, was it Canada, raising rates by 50 bips. Like
the UK have risen.
Maybe the Fed comes out and raises 50 bips. Like, let's talk about Australia. Like, Australia seems to be talking more and more about rate rises happening a lot sooner than they had originally thought. And I don't know. I feel like we've got a bit more to run here.
Yeah, I do too. I don't think it's immediate, but I think, I mean, like I said, it's going to happen at some point. We are at the beginning of the rate hike cycle. It will happen, but who the hell knows when? And who knows what interest rates will be at that point in time. I think you could probably safely say they're likely to be higher in the US than they will be in Australia, which would be the first time in a long time, I think, that would have happened.
Look, with everything that's going on now, economic data, like if you look at economic data from housing to employment to retail, forget how people are responding to surveys. If you're actually looking at what's going on, like the data's pretty strong, man. And you talk about property before. People don't build property unless they sell it. So unless people are selling the property, no one's building the property. No one's building. Do you know how many cranes are out here? It is maybe not. Oh, maybe even in Melbourne as well. But I'll look out, not exactly out the window, but up in the Gold Coast at the moment, there are cranes everywhere. New projects, developments have been sold, projects that have been sold, and they're going up because people have bought them.
Yeah.
And maybe by the time they finish, maybe by the time they finish in a year or so, or 18 months time, then it all hits the fan. We have a recession. But we've talked about this before. Like, I don't think we have to have like a depression style. I don't know why everyone's fearful of a recession. How else are we going to tame everything that's going on? Maybe a recession is what we need just to blow a bit of the air out of this thing. And so we can get back onto what we need to get back onto.
Yep. No, I agree. Agree with that.
Do you want to jump into director's cuts?
Yeah, mate. Let's do it.
What do you want to look at?
You go.
All right. So I looked at. I saw Tesla. I thought that was really interesting. Let me just get some of these numbers up. EPS $3.22 a share versus $2.27. Revenue up 81% to $18 billion. The company's sitting on $18 billion in cash, and they've got $88 billion in debt. And what are they, like $1 trillion company now? I had a look at the EPS going back to middle of last year. Q2 2021 EPS beat 48%. Q3 2021 15%. Q4 2021 7%. Q1 2022 42%. Like, what does Tesla need to do to prove to the public or to commentators and gurus that, hey, maybe it's actually a legit company? Like, maybe they are genuinely, they have transformed the automotive industry. There is no question about that. I don't know if you can compare, people are comparing Tesla to Netflix. I don't know if you can compare a Tesla to a Netflix. Like, their product, their branding, I feel like is more akin to the likes of an Apple or a Google. That's my personal take. What do you reckon?
Yeah, I think their positioning is very much like Apple. They've got high margins and margins that no other car company comes close to. We saw a couple of weeks ago that they don't advertise, so they spend more money on their car development and don't spend any on advertising. I've always kind of loved them as a concept, as a business, the way they operate. Love that Musk is just willing to just put his money where his mouth is and give it a crack and just kind of see what happens. And it wasn't all that long ago, maybe 5 years ago, there were pretty strong concerns that Tesla wouldn't be able to meet their debt repayments or be able to refinance some of their debt. I mean, it couldn't be further from the truth. And they're making tons of money. Their cars are, they've got such a lead in the car market, and everyone talks about BMW, Mercedes, Porsche doing whatever, going into electric. It doesn't matter. Tesla have such an advantage of battery technology that I think, I'm not saying it's insurmountable, I'm not saying they won't ever be dethroned, but man, they've just got such a lead, first mover advantage, in its purest form right there.
S&P, Tesla's fourth quarter results support prospects for investment grade rating in 2022. Like,
wow,
that's massive.
That's interesting.
Yeah,
that's really interesting. And speaking of earnings, Netflix kind of mentioned earlier, so they got absolutely pummeled a couple of nights ago. So their earnings actually beat. There was a slight beat on earnings, but the biggest issue that everyone's concerned about is they lost 200,000 odd subscribers, which in the grand scheme of things isn't a huge number, but I think it's the trend people are concerned about. So I think we looked last quarter that their subscriber growth had basically flatlined, and now it's obviously rolling over slightly. Interestingly, HBO and HBO Max, which is owned by, I want to say Comcast, I might be wrong there, but they added 3 million subscribers over the last quarter. So I don't think, it's not that people are cutting subscription services altogether. I think people are just being picky and choosy. I think they're cutting off one this quarter or this 6 months, and then they'll pick it up later.
Do you reckon we'll see more volatility in subscribers? Like, I'm gonna have Netflix for 6 months, and then I'm gonna jump onto Stan, etc. Like, do you reckon that's gonna be a thing?
Absolutely, I do, and because it's it's super easy to sign up. It's super easy to cut it off. There aren't that many new shows, and I found this with Netflix. I've got 7 or 8, 10 shows I absolutely love. I binge watch them all, and then I gotta wait 7 or 8, 9 months for the next season to come on board, and I don't watch a lot during that period. And I think during the pandemic we all signed up to everything because that's kind of all we had to do, and now we're going to go through a period of I like them, but I don't need this one all the time, and I don't need this one all the time. And Disney Plus offer an annual subscription, which is like 10 months of monthly subscriptions, if that makes sense. I think that model's really interesting. Netflix, I think they also announced a potential ad-supported version, which Disney announced last quarter. I think we.
So what does that mean? Like,
again,
you have a lower subscription model that's like $5 a month, but you've got ads in there, and it means that consumer, you're more likely to retain a subscriber rather than them chopping and changing?
Yeah, I think so. I mean, I think if you think about it, if I cut Netflix altogether, that's, I don't know what they are, $15 a month. But if I go the ad-supported version, there's $5 plus whatever the advertiser's paying. So maybe you get $8, $9 a month. So 8, 9 is better than 0. Not as good as 15. And this is how cable companies in the US started. They were all ad-free initially because you paid your subscription. And then they started introducing ads while pushing the prices up. And I don't think it's a surprise at all that the industry is heading that way. And I think it's probably going to be more and more common. Just one thing really interesting to note is analysts, before Netflix earnings, 61% of analysts had Netflix as a buy. Post earnings, about 37% have Netflix as a buy. The net average price target was $511. It's now at $366.
What a joke!
So,
like, people,
analysts being forward-looking as ever.
What a joke!
Crazy, so reactive, and they're so reactive. I mean, you look at their.
But it's not their fault. History. Like, how are they supposed to see into the future?
Well, I mean, if you look at management's guidance, I would say that's a much better indication of future performance than analysts' guidance. I mean, surely the company knows more than the analysts do. Analysts should just listen to companies, not go out there and try and make stuff up. All right,
tips and recommendations. What do you got for us, Matthew?
Mate, I'm. This is a bit of a shameless plug. So I'm going with The Voice, the new season of The Voice on Channel 7.
What?
Now, it's a shameless plug because what? What do you mean what?
The Voice.
So get on it, watch it. A friend of mine, Emerson,
Are you got a mate on it
this year? Mate, I got a mate. I have one mate.
What's his name?
He auditioned for it. Emerson Alexander.
Emerson
Alex. And I believe he's on this Monday. Now, he hasn't told me how he went. I suspect he's done pretty well. He's a pretty cool dude, very good singer. So shout out to Emerson, mate. I hope you did well, and just get on board, watch it, support him. I don't know. Anyway, so that was just a bit of a shameless plug for a mate. So
Nice.
That's what I got.
Nice.
What do you got?
All right. So big shout out to Avis Car Rentals. We're up in, as you know, up in Gold Coast, and we're on the 8th floor on surfers in a Wyndham thing. Mate, there's no vacancy here. You go up and down the Gold Coast, whether it's Miami, Mermaid Beach, like everything is just no vacancy and everything is pumping and jamming. Anyway, I took the beach bag out because I thought I'd be a good dad and I'll get the kids ready and the beach bag ready and whatnot and get ready for the day. Emptied the beach bag out, went over the balcony and shook the beach bag, and guess what fell out? Car keys. Rental car keys.
Yeah.
And it was this thing just fell like slow motion. And you know how in these retail complexes you've got like shops at the bottom and you've got like glass roofs that sort of sit. So if you look over the balcony, you just see a glass roof.
Like the awning.
Yeah, it's like a permanent awning, right?
Yeah.
And it just went bang on the glass, and I thought, oh crap! But then it kind of fell, and it fell into the gutter that sits between the building and the awning. And if only my golf was as good as this, guess where it fell into? Do you know what that is?
All in one.
A friggin' drain. I got a photo of it. I should actually. We'll get that photo up now, and I'll circle exactly where that thing fell. Dude, if my golf was as good as this, I would be Tiger Woods right now. But contacted Avis, and they had a spare key that afternoon, ready to roll. I think it was probably more luck of the draw, more than anything, the fact they had a spare key. But $700 down the gurgler for me, and
Wow.
yeah, there's 2 rounds of Movie World, 2 days of Movie World for the kids that we could have spent that on, but I'm not waiting 2 hours to get on Scooby-Doo, that's for sure.
Absolutely.
Hey,
one more shout out.
Yeah.
Just a colleague of ours, Rachel, who got married during the
Oh,
week.
Rachel.
Yes, and we laugh about this. So this was postponed 3 times.
Yes.
Because of COVID.
It's her 4th
so
wedding.
She finally got there. So
Yeah, we jokingly say
congratulations,
Rachel, it's her 4th wedding. Spewing I couldn't be there, Rachel, but massive shout out. I saw some photos and I heard that it was an excellent night. So yeah, that massive congratulations on being able to finally tie the knot. Mav can't get away now. He's locked, mate.
That's it. Locked in.
All right, info at baharianwealth.com.au. Flick us a note and we'll be back next week. Excuse the background here. It's a bit of a shambles, a bit of a mess. Hope you like the decor, but it's not ours. It's what was left on what was left of no accommodation up at Surfers at the moment. So the sunshine is good, but the beach is good. Doesn't change the accommodation.
Good for the travel stocks, right? Maybe they were a good buy. Who knows?
Maybe, and the airports aren't as packed as what everybody made it out to be. By the way,
Okay.
yeah, it's all bullshit. There was no one there.
Yeah. We'll see what it's like when you come back.
I'll keep you posted. All right, cheers, guys.
All right, guys.
Bye.
Cheers. Bye.